In August 2011, Warren Buffett published an op-ed in the New York Times. The third richest person on earth admitted that his federal tax rate that year was 17.4%. His personal secretary, Debbie Bosanek, paid 35.8. Same office, same year. Opposite tax rates. Buffett did not break a single law. The U.S. tax code, as written, taxes his kind of income lightly and hers heavily. That's not just a story about one billionaire. It's a story about how the tax code itself is designed. To understand why Buffett pays less than his secretary, start with what the tax code actually says. In the United States, wages are taxed at federal marginal rates up to 37%, plus 7.65% payroll tax, plus state income tax in most states. For a top bracket wage earner, the combined effective rate hits 40 to 45% on the last dollar earned. Long-term capital gains and qualified dividends are taxed at a federal top rate of 20%, plus 3.8% net investment income tax. Total, 23.8%. No payroll tax on capital gains. That's a 13 percentage point gap between what work is taxed at and what asset ownership is taxed at. Buffett's income consists overwhelmingly of long-term capital gains and qualified dividends from Berkshire Hathaway holdings. Bosanek's income is wages, same office, different income classification, different tax code. Now zoom up to the corporate scale. The U.S. federal corporate income tax rate was 35% before the 2017 Tax Cuts and Jobs Act. It was cut to 21% that year. But the effective tax rate for the largest U.S. corporations has been routinely far below 21%. Through transfer pricing to low-tax jurisdictions like Ireland and Bermuda, through accelerated depreciation, through R&D tax credits, through stock-based compensation deductions. Across the S&P 500, the average effective corporate tax rate in 2024 is approximately 13 to 15%. The asymmetry exists at every scale of the system. On paper, the case for the wages versus assets asymmetry makes sense. 5 clean arguments line up behind it. The double taxation argument. Corporate profits are taxed at the corporate level, 21% federal before reaching shareholders. Then capital gains tax is applied when shareholders sell. Total integrated rate on corporate income reaching individuals is roughly 40%. The shareholder rate alone looks low. The full chain is not. The capital formation argument: lower taxes on capital encourage investment. Investment drives economic growth. Higher capital formation produces higher wages over time. The asymmetry incentivizes savings and investment, which in theory benefits everyone. The risk-taking argument: equity ownership is volatile. Favorable tax treatment compensates for the risk. Wage earners trade risk for income stability. Investors trade stability for upside potential. Both deserve different treatment. The legal structure argument: corporations are subject to compliance, audit, and disclosure regimes that wage earners are not. The lower corporate effective rate reflects deduction of legitimate business expenses, equipment depreciation, R&D, employee compensation, interest, not avoidance. The international competition argument: if U.S. corporate tax is too high, companies offshore their domicile. The 2017 TCJA rate cut was partly a competitive response to Ireland's 12.5% rate. Lower rates keep tax base in the United States. 5 arguments. None of them wrong on paper. This episode isn't an indictment of capital or corporations or the tax code in general. It's a structural observation about a specific gap, the gap between the popular framing. Billionaires should pay at least the same rate as their secretaries, and the documented reality, which is that the U.S. tax code was written over decades to make sure that exact gap exists. Picture 4 corporate scale cases. Same wages versus assets asymmetry, different mechanisms, all legal. Case A, Apple's double Irish with a Dutch sandwich. Between 2003 and 2014, Apple ran a tax structure with a colorful nickname. Apple set up subsidiaries in Ireland that owned its intellectual property, logos, software, patents. Apple paid royalties to these Irish subsidiaries for using its own IP on every iPhone, every Mac, every iPad sold outside the United States. The Irish subsidiaries then paid royalties through a Dutch intermediary to a Bermuda entity. Bermuda has no corporate income tax. The result, Apple's effective tax rate on European profits dropped from 1% in 2003 to 0.005% in 2014. That is 0.1/1000th of 1%. Total overseas profit moved through the structure approximately $110 billion. In August 2016, the European Commission ruled that Ireland had granted Apple illegal state aid worth approximately 13 billion euros and ordered Apple to pay back taxes. Apple appealed. The case continued for years. By 2024, the EU Court of Justice had largely reinstated the order. Apple paid. The double Irish was closed in 2014. The replacement structure, the single malt arrangement, still using Ireland and now Malta, operates today. Case B, Amazon's 0 federal tax years. In 2017, Amazon reported U.S. pre-tax income of $5.6 billion. Federal income tax paid, negative $137 million. A refund. In 2018, Amazon reported U.S. pre-tax income of $11.2 billion. Federal income tax paid, negative $129 million. Another refund. How? Accelerated depreciation on warehouses, data centers, and equipment. Stock-based compensation deductions when employees exercise options, R&D tax credits under Section 41, net operating loss carry-forwards from prior years. Every line item was legal. The tax code was written to allow exactly this. Amazon's tax department exists to maximize it. Case C, General Electric's 2010 precedent. In 2010, the New York Times analyzed General Electric's tax return and found that GE paid zero in federal income tax on $14.2 billion of worldwide profit. GE used offshore subsidiaries, renewable energy tax credits, and an in-house tax department of roughly 975 people. Aggregate analysis by the Institute on Taxation and Economic Policy in 2022, 55 large profitable U.S. corporations paid an effective federal tax rate of 1.8% over 2018 through 2021. Statutory rate 21%. Case D, the carried interest loophole. Private equity and hedge fund managers earn most of their income as carried interest. A 20% share of fund profits. Under the U.S. tax code, carried interest is taxed as long-term capital gains, 23.8%, instead of ordinary income, 37%. A fund manager earning $1 billion in carried interest pays approximately $238 million in federal tax. The same billion earned as wages would generate roughly $370 million plus payroll taxes. Every U.S. president from Obama through Biden has proposed closing this loophole. None has succeeded. The PE/VC hedge fund industry employs the most active tax lobbying coalition in Washington, approximately $50 million per year in disclosed lobbying spend. 4 cases, 4 different mechanisms. One pattern: the tax on capital is structurally lower than the tax on labor. The corporate version is just the personal version with more decimal places. Most people picture tax avoidance as cheating. A clever individual finds a loophole. The tax system would work if not for a few bad actors. Sometimes that's true. Underneath it, 3 voices, 3 different decades of modern empirical work. Name what is actually happening at the system scale. Mechanism 1. Warren Buffett, in his August 2011 New York Times op-ed, did something unusual. He admitted publicly that he paid a lower tax rate than his employees, named it, and called for it to be corrected. My federal tax bill was only 17.4% of my taxable income. The Buffett rule, a proposed minimum 30% effective rate on millionaires, was introduced in the U.S. Senate in 2012. It failed to overcome the 60-vote threshold. Vote and 51 in favor, 45 against. Naming the asymmetry, even from inside, did not change it. Mechanism 2. In 2015, French economist Gabriel Zucman, now at Berkeley, published The Hidden Wealth of Nations, the first systematic measurement of global offshore wealth using national accounts data. Zucman's findings. Approximately 8% of global household financial wealth is held offshore in tax havens. The U.S. loses approximately $200 billion per year to offshore avoidance and evasion combined. Multinational corporate profit shifting to low-tax jurisdictions costs the U.S. Treasury an additional $70 to $100 billion per year. Before Zucman, the scale of offshore avoidance was estimated. After Zucman, it was measured, Mechanism 3. In 2019, Emmanuel Saez, Saez and Gabriel Zucman, both at Berkeley, published The Triumph of Injustice. The book combined Saez's decades of work on top income shares with Zucman's offshore measurements to produce the most complete picture of U.S. effective tax rates by income decile. Their headline finding? In 2018, for the first time in modern American history, the 400 wealthiest Americans paid a lower effective total tax rate, federal, state, local, corporate combined, than the bottom 50% of households. Top 400, approximately 23%. Bottom 50%, approximately 24.2%. The very richest taxed less than the working class across the entire system. This episode is the companion to episode 1.5. That episode covered the individual side, buy, borrow, die, Edward McCaffrey's 1990s framework, the ProPublica findings of 3.4% true tax rates for the top 25 wealthiest Americans, the Musk S-block mechanism. This episode covers the corporate side, same system, different scale, same designers. Buffett named the personal asymmetry in 2011. Zucman measured the offshore in 2015. Saez and Zucman framed the whole system in 2019. The mechanism is documented end to end. Once you see the mechanism, the rest of the story is what it costs, at the scale of one country and one tax base, at the aggregate scale. The U.S. loses approximately $200 billion per year to offshore wealth avoidance and evasion combined. Per Zucman's 2015 baseline measurement, updated for 2024 conditions. Multinational corporate profit shifting costs an additional $70 to $100 billion per year. Total foregone federal tax revenue from corporate and individual avoidance, approximately $270 to $300 billion per year. For perspective, that lost revenue is roughly equal to the entire U.S. federal Medicaid budget. It is approximately half the U.S. Defense Department budget. It is roughly 10 times the U.S. State Department plus all foreign aid combined. At the corporate effective rate scale, ITEP's 2022 study of 55 large profitable U.S. corporations across 2018 through 2021 combined pre-tax profit $66 billion. Combined federal income tax paid $1.2 billion. Effective rate 1.8%. Statutory rate 21%. The S&P 500 average effective rate is closer to 13 to 15% in 2024, already meaningfully below the statutory rate before any of the worst-case avoidance structures. At the individual scale, a U.S. wage earner making $80,000 pays an effective federal income tax plus payroll tax rate of approximately 18 to 22%. State and local taxes add another 5 to 10%. Total burden, roughly 25 to 32% of every dollar earned. A billionaire whose wealth comes primarily from unrealized stock appreciation pays, by Saez+Zucman's measure, including all forms of tax, approximately 23%. By ProPublica's true tax rate measure that includes unrealized gains, the top 25 paid 3.4% on their actual economic gains. The wage earner's effective rate is 2 to 10 times the billionaire's. The system was not broken. It was working exactly as designed. This episode is sponsored by my own private community. If watching the gap between Buffett and his secretary made you want to go deeper into how tax design actually transfers wealth across generations, this is built for it. A deep dive community where I work through over 100,000 breakdowns, how each loophole was written, who lobbied for it, how the legal structures actually flow, how the math works at every income level, not theory, sources, and citations. Link is in the description below. All right, back to the diagnosis. Once you see the mechanism in full, the brief's closing line lands honestly. The U.S. tax code is approximately 6,800 pages of statutory text, plus 75,000 pages of regulations and case law. Every page was written by someone. Every loophole was inserted by a coalition with money to defend. The tax code was not designed neutrally. It was designed over decades by the people most affected by it. For the individual wage earner, this means three things. There is no neutral tax system. Every code is a set of policy choices. The U.S. chose to favor capital. Northern Europe chose to favor labor more. The choice is political, not technical. Reasonable people can disagree on which is better. Both are designs. There is no exit from your position inside it. If you earn wages, you pay the higher effective rate. If you own appreciating assets, you eventually pay the lower one. The path from one to the other is most of what personal finance is structurally about. There is no immune coalition. The Buffett rule failed in 2012. Carried interest survived every Democratic president's promise to close it from 2008 onward. The double Irish was replaced by single malt. Apple paid back taxes in Ireland after a decade of EU litigation, then kept operating. That doesn't mean nothing changes. OECD Pillar 2, the global 15% minimum corporate tax, entered force in the European Union, the United Kingdom, Canada, Japan, and Korea in January 2024. The U.S. partially implements through the Corporate Alternative Minimum Tax in the Inflation Reduction Act of 2022. The IRS received $80 billion in additional funding from the same act, mostly for enforcement. The ProPublica secret IRS files made the asymmetry public in 2021 in a way it had never been before. But for the median U.S. wage earner today, the system still operates as Buffett described it in 2011. Same office, opposite tax rates. Recognition of which side of the asymmetry you stand on is the first move. 3 operational rules to take from this. Rule 1, read the tax classification, not the dollar amount. The same $1 million taxed as wages produces approximately $370,000 in federal tax plus payroll taxes. Taxed as long-term capital gains, approximately $238,000. Taxed as qualified business income for a pass-through entity, somewhere in between. The classification matters more than the amount. Before any major financial decision, know what income type you are creating. Rule 2. Episode 1.5 covered the individual side. This episode covered the corporate side. Both rules from episode 1.5 still apply. Don't sell what compounds, borrow against it if liquidity is needed. Hold appreciating assets to death where possible to capture step-up basis. Know your effective rate, not your marginal rate. The mechanisms scale from individual to corporate, but the underlying logic is the same. Capital is taxed more favorably than labor. Rule 3, watch the policy moves that actually change the math. OECD Pillar 2 is real. The corporate alternative minimum tax under the IRA is real. The IRS audit capacity funding is real. None of these will eliminate the asymmetry, but they shift the margins. Track the legislation that actually moves through Congress, not the headline proposals that never get to a floor vote. These are operational rules, not philosophical ones. They give you a way to navigate the system without believing that the design is accidental or that you can opt out of it. In August 2011, Warren Buffett admitted in the New York Times that he paid 17.4% in federal tax. His secretary paid 35.8%. Same office, same year, opposite tax rates. 8 billion people now wake up every morning inside an economic system where the tax code, as written, systematically rewards capital ownership and punishes wage labor. Buffett named it in 2011. Zucman measured it in 2015. Saez and Zucman framed the whole system in 2019. The Buffett rule failed. The carried interest loophole survived. Apple paid back taxes in Ireland, but kept its structure operating elsewhere. The mechanism is documented end to end. If you want more breakdowns like this, and subscribe. There's a lot of math worth understanding. Numbers don't lie, but they don't explain